based on the momentum of this initial drop and the strength of the bounce is going to tell us kind of what the momentum and the strength and where the next downside targets are for silver. So if we were to just use this as the analysis, we have again the initial sell-off in price, then we had the bounce, and the way Fibonacci theory works, I find for the most accurate move is this 618, which is known as the golden ratio. And when price comes down and tests this level and then potentially pauses there, we almost always see the price continue all the way down to the 100% measured move. So that's more or less saying the size of this drop is going to happen again once it's had this correction. And so that is the second half of this drop. So it is pointing to about $39, $40 per ounce in silver. Now,
precious metals are signaling a major trend reversal, warning investors that holding blindly through market pullbacks can severely impair capital. From an analytical standpoint, technical chart structures often front-run fundamental shifts, making strict risk management essential right now. Chris Vermeulen, a veteran technical strategist, calculates that precious metals are locked in a classical Fibonacci breakdown pattern. According to his analysis, silver's bear flag configuration points toward a downside prediction of $39 to $40 per ounce. Similarly, gold's technical failure at key Fibonacci golden ratio levels projects an upcoming drop toward the $3,300 to $3,600 range. Falling 50-day and 150-day moving averages further confirm that commodities are entering a prolonged bear market, amplified by stock market liquidation and a surging greenback. Navigating this climate requires cash preservation rather than trying to catch falling knives during volatile market washouts. Now, we present the clips from Chris Vermeulen's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
The charts I'm looking at, the time frames haven't changed. I still have the same targets. We're still letting these bigger patterns play out, which is around $40 for silver. It's also about $3,600, potentially $3,300 for gold. So there's still quite a bit of downside left, but it seems everybody's getting really bullish at this moment. Just the way the charts are kind of setting up, and from some standpoints, some people are thinking, it's found support, the metals space. But overall, I mean, we're still seeing weakness, and there's weakness in other areas that are going to bleed over potentially into the precious metals space, like the equities market. If selling starts there, it's going to put pressure on metals. If we see the dollar start a new leg higher, that's going to put pressure on. So there's a lot of downward bias, a lot of things pointing. That's going to put a lot of headwinds for metals for sure. If we take a look at the daily chart of silver, really we've had a initial huge the bubble kind of burst initially, this huge drop, and that's kind of the first leg down. And I like to use what I call, or what's called, Fibonacci extensions. This is using Fibonacci theory. If listeners don't know what it is, definitely go look it up. I actually did a video about Fibonacci theory online, but more or less it's telling us, based on the momentum of this initial drop and the strength of the bounce, is going to tell us kind of what the momentum and the strength and where the next downside targets are for silver. So if we were to just use this as the analysis, we have again the initial sell-off in price, then we had the bounce, and the way Fibonacci theory works, I find for the most accurate move is this 618, which is known as the golden ratio. And when price comes down and tests this level and then potentially pauses there, we almost always see the price continue all the way down to the 100% measured move. So that's more or less saying the size of this drop is going to happen again once it's had this correction. And so that is the second half of this drop. So it is pointing to about $39, $40 per ounce in silver. Now, a lot of people are seeing silver as potentially bottoming here. People are saying it's bottomed, it's put in a double bottom. This is a significant pivot zone on the chart. I mean, if you kind of drag this across these levels, it is definitely a support level, a short-term support level for silver. But overall, the trend is down. The really easiest way to get an idea, there's two easy ways to identify the trend and what likely is going to happen with any asset class. The first one is if it has a series of lower highs, if it has a series of lower lows, that is the definition of a downtrend. It's channeling lower, right? So the odds are a trend is going to continue than it is to reverse. So just based on falling price alone, it's telling us that this pause right here is actually probably seen as a bear flag pattern, and we're going to see another move down. The other really, really simple way to identify kind of the overall trend is simply look at the moving averages. When we look at the moving averages, we've got the long-term 150-day moving average sloping down. Typically, if it is sloping down and prices below it, you're in a bear market. And so I believe gold and silver are in a bear market. They've both corrected well more, a lot over 20%. We've got the 50-day moving average, which is the intermediate trend. We got the 20-day moving average sloping down. We got the 5-day layered below it. So everything on the silver chart is saying, hey, the trend is likely going to continue to go lower, and that's both long-term and short-term. So, people are kind of a little bit excited here because people are thinking it's putting in a double bottom. It's kind of at this breakout zone. But again, when you look at the trends and step back, this is really just at this point a technical bounce. It's finding short-term support. Each time it tests it, it's going to be eating up some of that supply. And then eventually it is probably going to resolve to the downside. If we come and we look at silver here for the $50 mark, it's a whole number. As you and I have talked before, usually if you're above a whole number and your drop price is falling towards it, people are naturally going to be like, hey, I'm going to buy it at $50. That's going to be a great deal. There's something about decade numbers, so $40, $50, $60, and whatever side you're on of that, if price is above it and falling, there's going to be natural people wanting to buy around that $50 mark. It's just that psychological level. It is obviously a critical high that was done back in 2011. But it doesn't mean it's going to hit that to the T and then just take off. It can still trade through it. It can still drop sharply below it. Silver is very volatile, as we know, so it generally will have very long wicks. So even if it was to come down to 50, who knows? It could have like an intraday or an intra-week swing where it drops all the way down to 40 or dips below it and then rallies back by the end of the bar and closes at 50. And people will be like, oh, 50 held up. But I mean, nothing is that perfect, right? You have to expect a lot of wiggle room in silver. It could fluctuate probably $10 below that easily. But overall, it will most likely be a technical bounce. When silver comes down to the $50 mark, potentially over the next few sessions or over the next couple of weeks, there's no doubt, you watch the intraday chart, you'll probably see on the order books, you'll probably see a big stack of people wanting to buy ounces and buy, contracts at that level. The question is, can it hold, right? It's just a technical bounce. It's not actually, I don't think it's going to be a solid support level.
Silver's daily chart exhibits a classic bear flag setup, characterized by sequential lower highs and lower lows, while retail sentiment often anchors around the psychological $50 milestone. Repeated retests are systematically draining buy-side liquidity. From a broader market perspective, relying purely on whole number psychological levels without structural confirmation is a common retail trap. Technical indicators suggest this temporary consolidation will soon resolve to the downside, with extreme volatility potentially forcing a sudden prediction of an intraday washout spike down to $40 per ounce before recovering. Downward sloping 20-day, 50-day, and 150-day moving averages solidify the presence of heavy institutional distribution. Counter-trend rallies in a confirmed bear market typically offer exit opportunities rather than genuine long entries. Now, let's get back to the interview.
Gold has done a few different levels. It initially had its first big drop and its bounce, and then it had its next measured move. So, I mean, we can just draw this out. We had the initial drop, and then we had the bounce. And as you can see here, let me just draw on the chart and zoom in a little bit because this is important. We saw the initial drop, and then we had the bounce, and then we came down, we pierced right through the 618 level. It just continued to free fall, and it did obviously have a big wick through it, but it came down, hit the 100% measured move level, and then started to bounce. So that initial drop that silver is still working on, gold has already completed that. And so now we have to look at the next move for gold. And so the next move for gold is the next series high. Is this high? It's followed by the big sell-off. and then the bounce. And if we just kind of carry that forward to where we are now, you can see those levels. We are at the 618 level. As I mentioned before, if you hit this level and there's a hiccup or a pause on the chart, usually we're going to see price unfold and fall down to this 100% measured move, which is about $3,600 per ounce. So there's still some pretty good downside potential in both gold and silver. And I do feel like if they actually hit those levels, I think it's going to create a lot of panic selling. There's going to be a lot of fear. I don't think a lot of people are expecting gold and silver to break down here. I mean, there's a lot of people betting and stacking right now as saying that, it's turned a corner and things like that. So overall, this is where we could start to see a very sharp drop and then actually see some panic selling. And even if, gold comes down to 3,500, it might have a huge, intraday move or throughout the week have a huge washout low and then maybe recover back. So I'm expecting a lot of volatility in the precious metal space, which I think is a great opportunity. It's going to cleanse the market, get us down to some critical, I think, fair value levels for where we can move into precious metals for a long-term position. We can look at the monthly chart of gold. You can see how it goes through these sequences. You can have a huge run, then it can go dormant for decades. Again, we had another big run through 2000, peaked in 2011, and then it went dormant for 15 years before it really broke out and started to run again. And here we are again at another one of these big peak phases, right? It's like if you go and you look at these giant, turning points in the markets where it has these huge rallies, we are back into another one. So the big question is, which is what you're asking, is like, how long is this going to take? And that's kind of the concern, right? We don't know if it's going to take 2 months or a month and just wash out and turn around and take off, or if it is going to do a lot like what it did in 2011, 2012, maybe it trades sideways and holds up, and then eventually it kind of has a breakdown and it just sells off for several years and builds a rounding formation, just like what the dollar is doing. So this could sell off and struggle for a while and eventually put in its new launch pad and then work its way up to 8,000, 12,000 and all of that. Again, long term, I'm extremely bullish on precious metals, but I do think there's still quite a bit more downside. And the biggest concern to me is actually this blue box right here. This is like, a 10-year, 15-year window of no return. And that could happen again. I doubt it, but it could take several years still. And the last thing you want to do is, have your money just sitting there not working for you. It needs to be working for us with inflation and everything going on. You got to make sure it's protected, number one, and number two, it's working for you in some asset class, right? If precious metals aren't favorable, you've got to go somewhere else temporarily, and then you can go back into precious metals when they become favorable and start that next major leg up. The other big thing, Elijah, is the US dollar. When we zoom in here on the US dollar, we've had this initial big bottom. You and I have talked about this many times. This is a level we've been looking at for a long time, as a breakout out of this rounding base, the stage one kind of basing formation for the dollar. And now the dollar it's doing exactly the opposite of what precious metals are doing. It has a series of higher lows and a series of higher highs. That's the definition of a downtrend. It's broken significant pivot highs, is broken out of this rounding formation, and it's pointing to much higher pricing. And the dollar strengthening is telling us, I think there's kind of some big global concerns going on. Something big is about to unwind. We're probably going to see the US dollar start to skyrocket, which is going to put pressure on the on metals in general. And of course, the equities market will sell off. So there's a lot of things coming together. Again, we've got the dollar here starting what looks to be a new bull market. This is long-term trend stuff. We have both gold, silver, and miners all actually turning into a new bear market. They have the long-term trends down. They're breaking down on all time frames. So this is huge. This is very big. A lot of people don't want to accept the fact that, hey, technically gold and silver are in a bear market and the dollar is in a bull market. That is not going to bode well for precious metal investors at the moment. It's going to be a great opportunity to get into precious metals and miners down the road. It's going to be a fabulous opportunity that I can't wait for. But right now, you do not want to stay on a sinking ship at this point.
Gold has completed its initial drop and is now faltering at crucial Fibonacci golden ratio resistance, signaling an impending secondary sell-off. A breakdown below current consolidation levels projects price targets toward $3,500 per ounce, likely triggering widespread market panic. This weakness coincides with a major bullish breakout in the US dollar index, which has cleared a multi-year stage 1 rounding base. A surging dollar creates severe macro headwinds for physical bullion and mining equities alike. While this multi-year consolidation phase may freeze capital growth in the short term, cycles like these are healthy. They wash out excessive leverage and reset asset valuations to true fair value. Looking further ahead, once this macro cleansing cycle finishes, gold is predicted to establish a generational launching pad, eventually embarking on a powerful secular bull run targeting $8,000 to $12,000 per ounce. Remaining patient and strategically protecting liquidity during bear phases is what ultimately separates consistent investors from the crowd. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.